In more than 40 years in banking, I have witnessed nearly every type of financial crisis you can imagine. Market crashes, currency collapses, wars, pandemics, hyperinflation, and deflation. I have seen assets once considered untouchable completely disappear. And I have also seen other assets consistently hold their value, or even rise, during the worst economic disruptions in history. Most investors concentrate on chasing returns, attempting to time the market, or searching for the next popular investment trend. But after overseeing trillions of dollars through multiple economic cycles at JPMorgan Chase, I have learned that the most important investment question is not what will make me rich. It is what will ensure I never become poor. There are specific assets that have protected and increased wealth for centuries through every possible economic disaster. These are not speculative plays or quick rich schemes. They are foundational assets representing real tangible value that exists independently of government policy, currency swings, or market sentiment. Today, I want to outline 5 assets that, based on centuries of historical evidence and core economic principles, will not lose value over the long term. These are the assets that smart capital, sovereign wealth funds, family offices, and institutional investors quietly accumulate and hold in all market environments. The first asset that will not lose value is physical gold held in your direct possession. Gold may seem outdated in our digital era, but there is a clear reason central banks worldwide have been purchasing it at record levels over the past decade. Gold is not primarily an investment. It is insurance against the breakdown of everything else. At JP Morgan, we operate one of the largest precious metals businesses globally. We safeguard gold for central banks, sovereign wealth funds, and some of the wealthiest families in the world. These are not speculators. They are highly sophisticated financial institutions. And they hold gold because they understand something many individual investors overlook. Gold is the ultimate store of value. For more than 5,000 years, gold has preserved purchasing power across empires, currencies, and economic systems. When the Roman Empire collapsed, gold retained its worth. When the Spanish peso failed, gold maintained its value. During the hyperinflation of the Weimar Republic, gold not only preserved wealth but became a preferred medium of exchange. What makes gold especially important today is the environment we are living in. We are in a period of unprecedented monetary experimentation. Major governments are running significant budget deficits. Central banks are expanding money supply at levels never before seen. The global financial system is highly leveraged and more fragile than at any time in recent memory. When confidence in paper currencies declines, investors turn to gold. Not gold ETFs, not mining stocks, but physical gold you can physically possess. During the 2008 financial crisis, while banks were collapsing and equity markets were falling sharply, gold rose by more than 25%. During the market panic of 2020, gold reached record highs as investors sought protection from currency debasement and economic uncertainty. The key factor is direct ownership. Gold ETFs can be influenced by market mechanics. Mining companies can face operational or financial failure. Futures contracts may settle in cash instead of physical metal. But physical gold stored securely represents tangible value that exists regardless of what happens to financial markets or banking systems. How much should you allocate? I recommend holding 5% to 10% of your total assets in physical gold as protection against systemic risk. It is not intended as a growth strategy, but as a store of value designed to preserve purchasing power when other assets falter. The second asset that will not lose value is productive agricultural land with secure water rights. People will always require food, and fertile land with dependable water access is becoming increasingly limited as global population expands and climate patterns shift. At JP Morgan, our agricultural finance division has monitored farmland values for decades, and the long-term direction has been clearly upward. However, not all farmland offers the same protection. Agricultural land that truly maintains value has 3 critical features: rich soil, reliable water supply, and stable climate conditions. Land meeting these standards has appreciated steadily for over a century, regardless of broader economic cycles. During the Great Depression, while stocks lost nearly 90% of their value and banks failed nationwide, prime agricultural land in the Midwest maintained its worth and continued generating income through crop production. During the stagflation of the 1970s, farmland became one of the strongest performing asset classes as rising food prices kept pace with inflation. Today, global food security concerns are increasing the importance of productive farmland. The world's population is projected to approach 10 billion by 2050, requiring approximately 70% more food production. At the same time, urban expansion is reducing available farmland at historic rates, and climate change is disrupting growing conditions in many traditional agricultural regions. Water rights in particular are essential. Let's approach this as a focused exercise. You are a professional YouTube scriptwriter and skilled paraphraser. Your objective is to transform the following transcript into a polished professional script while preserving its original structure and overall length. Many of the world's largest aquifers are being drained more quickly than they can naturally refill, and surface water supplies are becoming increasingly unpredictable due to shifting rainfall patterns. As water scarcity intensifies, agricultural land with senior water rights will continue to rise in value. At JPMorgan, we have financed agricultural land purchases for institutional investors, pension funds, and sovereign wealth funds that recognize the long-term investment potential. Nations such as China and Saudi Arabia have acquired farmland globally to protect their food security. For individual investors, the main obstacle is that high-quality farmland demands substantial capital and operational expertise. However, agricultural REITs and farmland investment funds offer access to this asset class without requiring hands-on management. The third asset that is unlikely to lose value is essential utility infrastructure with monopolistic features. Electricity, water, natural gas, and telecommunication services will always be necessary. Companies that own and operate the infrastructure delivering these services, especially in markets where they benefit from natural monopolies or regulatory protection, represent some of the most stable and valuable holdings in the economy. At JPMorgan, we finance utility infrastructure projects worth hundreds of billions of dollars and have consistently observed their resilience across economic cycles. During recessions, consumers may reduce discretionary spending such as dining out or travel, but they do not stop paying for electricity or water. In inflationary periods, utility providers often have the capacity to adjust rates to protect their margins. The strategy is to prioritize utilities that deliver essential services, hold dominant market positions, and operate within regulatory systems that permit reasonable returns on capital. Electric utilities in expanding regions, water utilities supported by long-term agreements, and natural gas infrastructure companies all align with this profile. Looking ahead, the most strategically important utility infrastructure is tied to the digital economy. Data centers, fiber optic networks, cell towers, and cloud infrastructure are becoming as critical today as electricity and water were in the 20th century. Companies such as American Tower, which owns cell towers, and Digital Realty Trust, which owns data centers, control infrastructure that is positioned to grow in value alongside the digital economy. Demand for data storage and transmission is expanding at an exponential pace, and the firms that own the physical infrastructure supporting this growth possess significant pricing power. These projects require massive capital investment and regulatory approvals, creating high barriers to entry. Once operational, they typically produce steady cash flows for decades and often appreciate as demand increases. The fourth asset category that retains long-term value is shares in companies producing essential goods with strong brand loyalty and pricing power. Not all publicly traded companies are equal. Although the broader stock market can be volatile, certain firms have consistently preserved and expanded their value across economic conditions because they supply products people require regardless of the economic environment. Examples include Johnson & Johnson, which manufactures medical products and pharmaceuticals that remain necessary in any climate. Procter & Gamble, which produces household essentials such as detergent and toothpaste purchased in both strong and weak economies, and Coca-Cola, which has built brand loyalty so powerful that consumers are willing to pay premium prices even when lower-cost substitutes exist. At JPMorgan, these are often referred to as widow and orphan stocks, stable enough for conservative investors yet capable of delivering solid returns. These companies generally share several defining traits: essential products, strong brands, global distribution networks, pricing power, and reliable dividend payments. The most valuable among them possess what Warren Buffett describes as economic moats, durable competitive advantages that shield them from competition and sustain high profit margins. These advantages may include brand strength, regulatory approvals, network effects, or cost efficiencies. During the 2008 financial crisis, while many financial and speculative stocks declined between 50% and 90%, several essential product companies actually appreciated as investors sought safety. Johnson & Johnson's share price ended 2008 higher than it began, despite the most severe financial crisis since the Great Depression. These businesses also tend to raise dividends consistently, creating growing income streams that help counter inflation. Many have increased dividends annually for 20, 30, or even more than 50 consecutive years. The focus should be on companies offering truly essential products, not merely popular ones. Apple produces desirable technology, but consumers can postpone upgrading devices during economic downturns. In contrast, medicine, food, and basic household necessities cannot be deferred. The fifth and final asset category that maintains long-term value is real estate in prime locations characterized by limited supply and strong demographic support. While real estate as a broad category can be cyclical and risky, specific property types in select locations have demonstrated the ability to preserve and grow value across economic cycles. The determining factors are location, scarcity, and fundamental demand drivers. Prime residential properties in major metropolitan areas with robust job markets, quality schools, and physical or regulatory limits on development have appreciated steadily for more than a century. Markets such as Manhattan, San Francisco, Central London, and Hong Kong have experienced short-term corrections, but their long-term trajectory has consistently trended upward. Commercial real estate leased long-term to creditworthy tenants also fits this framework. Office properties occupied by government agencies, medical facilities in expanding communities, and retail locations in high-traffic prime areas represent real estate capable of maintaining value through varying economic conditions. At JPMorgan, we finance real estate investments totaling hundreds of billions of dollars, and our experience shows that the properties best able to preserve value share three traits: irreplaceable locations, constrained supply, and strong underlying demand. Irreplaceable locations are those where development is restricted by geography, regulation, or physical limitations. Additional oceanfront land cannot be created, nor can more land be added to Manhattan or new sites replicated next to major universities or employment hubs. Limited supply ensures that even if demand fluctuates, scarcity establishes a floor under property values, particularly in markets governed by strict zoning laws or environmental constraints that restrict new construction. Strong underlying demand is driven by demographic shifts, economic expansion, and unique features that make certain areas attractive. Rising populations, employment growth, universities, and cultural attractions all generate consistent demand for real estate. The difficulty with investing in property is that it requires substantial capital, includes transaction expenses, and can be illiquid. However, real estate investment trusts, REITs, that hold high-quality properties in prime locations offer access to this asset class with improved liquidity and lower capital requirements. Now, let me clarify why these five asset classes are fundamentally different from most other investments and why they are positioned to retain value over the long term. First, each represents real, tangible value rather than purely financial claims. Gold is a physical asset, farmland produces food, utilities deliver essential services, core consumer companies manufacture necessary goods, real estate provides shelter and usable space. These assets hold intrinsic value that exists independently of financial markets, government policy, or economic cycles. Second, they all benefit from scarcity. The supply of gold above ground is limited. Arable land is finite. Infrastructure locations are restricted. Only a small number of companies maintain dominant competitive positions. Prime real estate is also limited. Scarcity supports value and helps protect against dilution. Third, demand for these assets tends to grow over time. Population growth increases the need for food, housing, and consumer products. Economic progress raises demand for utilities and infrastructure. Urbanization strengthens demand for prime property. These are structural, long-term trends that are likely to persist despite short-term economic volatility. Fourth, they have demonstrated resilience across multiple economic cycles. Each of these asset classes has preserved or increased value through wars, recessions, hyperinflation, deflation, and other financial crises throughout history. Finally, they provide ongoing income or direct utility while preserving capital. Farmland generates crop revenue. Utilities distribute dividends. Essential companies pay dividends. Real estate produces rental income. Investors are not relying solely on price appreciation. They receive income while holding the asset. The effective way to implement this strategy is through diversification across all five asset classes instead of concentrating capital in one area. A balanced allocation could include 10% in physical gold, 15% in agricultural land or farmland REITs, 25% in utility stocks and infrastructure, 30% in essential consumer companies, and 20% in prime real estate or REITs. This structure creates exposure to different forms of value preservation while lowering the risk that one asset class underperforms. It is also essential to recognize that these assets are not intended to maximize short-term gains. Their purpose is to preserve and steadily grow wealth over decades. In certain years, growth stocks or speculative assets may significantly outperform. However, over extended periods, these 5 categories are expected to deliver consistent, dependable returns with a much lower probability of permanent capital loss. At JPMorgan Chase, our investment philosophy has long been centered on the idea that protecting capital is more important than maximizing returns. Affluent families and major institutions apply this principle when structuring their portfolios. The 5 asset classes outlined here form the foundational holdings that should anchor any long-term wealth preservation strategy. They are unlikely to generate rapid wealth overnight, but they are designed to help maintain and protect wealth over time, regardless of future economic uncertainty. In a world facing elevated risks to paper currencies, financial systems, and economic stability, these assets provide genuine security and represent a disciplined approach to safeguarding your family's financial future.